Retail trading manuals often present the double top as a simple geometric puzzle. Spot the two peaks, sell the breakdown of the middle, and follow the lines to a predictable profit. But the live market rarely produces the clean, symmetrical shapes found in textbooks. Traders who enter based on the visual perfection of a chart often find themselves holding losing positions as the price moves against the expected path. When this sterile M shatters, it exposes the volatility that retail models try to simplify. A single large candle can invalidate the entire geometry, leaving those who traded the shape without an exit. Large institutions manage capital on a scale that makes simple execution impossible. If a fund attempts to enter a massive short position all at once, they risk collapsing the price before their orders are even filled. They need a deep reservoir of buyers to absorb their volume. This operational requirement leads institutions to look for areas where retail activity is highest. Highly visible patterns are used to manufacture the necessary buying volume from the retail crowd. Navigating this requires a shift from identifying shapes to tracking the movement of trapped capital. The focus moves from the lines on the screen to the areas where trade volume is forced to cluster. Trading the geometry effectively provides the liquidity for those on the other side of the trade. Survival in these markets depends on recognizing the psychological mechanics occurring behind the candlesticks. We can track this process in real time by examining a standard range breakout, an event that immediately signals to the retail market that a move is underway. As price clears the consolidation box, printing a new high, retail traders see a confirmed breakout and aggressively enter long positions. Placing protective stop losses below the recent swing low creates a technical floor known as the neckline. The price arches back to test that support, then rises, failing just shy of the previous high, establishing the secondary peak. This failure to break out a second time creates an opportunity for traders who missed the first rally. Motivated by the fear of missing out, these late traders buy the second peak, stacking even more stop-loss orders at the exact same neckline established by the first group. This neckline now represents a concentrated pool of stop-loss orders. It is a dense, high-volume pocket of sell-side liquidity waiting to be triggered. The resulting M shape is a byproduct of institutions baiting retail traders into consolidating their risk into a single, vulnerable location. Activating the trap requires a physical breach of the neckline. The market must move into that liquidity pool to fill the institutional orders. When a strong bearish candle pierces the neckline, it triggers the massive cluster of retail stop-losses. As those stop-losses hit the tape, they execute as sell-to-close orders. This sudden, massive flood of sell orders generates the localized panic that drives the price down with extreme speed. The panic from retail sellers provides the exact buying liquidity institutions need to fill their large short setups at profitable prices.
Professional execution in this scenario waits for a specific confirmation. A short entry is only considered once a bearish candle closes firmly below the neckline. To manage risk, a stop-loss is placed just above the wick of that breakdown candle, ensuring the trade is invalidated if the momentum fails to hold. The logical profit target is the original point of the bullish breakout, the level where the next major pool of capital is likely to be found. As retail sell orders flood the market, the price experiences a violent downward push, fueled by forced exits of trapped buyers. This cascade is a structured transfer of risk, using engineered panic to move capital from retail participants to institutional hands. Deviating from the textbook often provides even clearer signals. Perfect symmetry is less important than understanding how momentum is used to create bad entries. An asymmetrical top forms, followed by a colossal red candle smashing through the neckline. Its sheer speed provokes a reaction. Retail bears want to short this breakdown, but entering here forces a massive stop-loss with minimal profit potential. Price then violently snaps back to the neckline, stopping out late bears before the final move. To avoid this, professionals look for a safe retest entry rather than chasing the initial momentum. The entry signal is a bearish engulfing pattern that rejects the neckline from below, providing an institutional footprint that resistance has been successfully established. Placing a stop-loss above the wick of this engulfing pattern keeps the risk tight, while confirming the trade is aligned with the new downward trend. Waiting for the retest and the rejection prevents a trader from being caught in the volatility of the initial breakout and subsequent reversal. The core of this analysis is that a break of a daily high has little value without the structural support to maintain it. Here, the price pushes above the previous high, but stalls immediately. The weak, flat-bodied candles indicate that no new buyers are entering the market at these higher prices. This lack of follow-through suggests the market is top-heavy, indicating the move was engineered to trap breakout buyers. As optimism fades, the price rolls over. The neckline breaks, and the price accelerates downward as the localized liquidity pool is drained. The double top formation appears when buying exhaustion meets the algorithmic requirement to fill institutional orders. Recognizing this requires moving past the search for geometric patterns. The focus should remain on identifying where retail stop losses are likely to be clustered before any trade is initiated. By mapping out these points of forced exit, a trader can see the market's hidden architecture, the network of data points that actually dictate movement. The advantage belongs to those who anticipate the panic of others.
Profitable trading comes from observing the mechanics of the trap, rather than simply following the shapes left behind in the wake of the move.